The Zacks Rank, value, momentum, growth, and income all factor into Zacks Rank buys.
Hey, there's another REIT on the growth and income radar, and our growth and income strategist, Todd Bunton, wants you to know more about it, and so that's why he's joining me now to talk about it. This one is in the medical area, Medical Properties Trust, MPW. They own healthcare facilities.
Exactly, yep. They have 138 properties, the majority of which are general acute care hospitals. They also have rehabilitation hospitals, longer-term acute care hospitals. Primarily in the United States, over 90% of their properties are in the U.S., Texas and California being their biggest markets. They do have a little bit of exposure in Europe, actually. They have some properties in the UK and Germany.
Oh.
Yeah, but yeah, majority of the revenue comes from the U.S., and they're landlords, so they don't operate the hospitals at all.
Yeah.
And most of these are net leases, which means the operators themselves pay all the property taxes, they pay all the maintenance and all that. So really, these guys just collect the rent checks on there.
Hey, not a bad way to go.
Exactly, yeah. So that allows them to generate very solid, steady income, and allows them to pay a very solid dividend, which I'll talk about.
Income.
Yeah, I'll talk about that a little bit more in a second. But first, I want to talk about the earnings momentum. The company has seen a nice little uptick in consensus estimates for both 2015 and 2016 from analysts, sent it to a Zacks Rank of 2, which is a buy rating. And then in terms of growth, analysts are expecting about 18% funds from operation growth this year and 6% next year. Now, funds from operation is essentially net income plus depreciation. Okay. So as a property owner, you know, they have to deduct depreciation expenses. Of course, that's a non-cash expense. So we like to add that back in when we're analyzing these. So we use the funds from operation metric instead of your typical earnings per share metric.
Got it.
But good growth expected over the next couple years. And then that dividend, they pay a dividend that yields 5.9%.
I saw that. Recently increased by 5%.
They did. That's right. So they recently increased it, by 5%. Almost 6% yield in a market where the 10-year is getting less than 2%. I mean, that's fantastic.
Yeah.
And you can see, compared to their peers, that's still one of the highest yields in the REIT space. I brought with me, you can see a list of 3 other healthcare style REITs, and Medical Properties Trust beats them all on the yield here, and beats them on valuation. You can see they traded just 12 times forward funds from operation. That's a significant discount to some of its peers, and they have the good earnings momentum to go along with it. So a lot to like about this REIT. The one caution I would say, the one risk here you want to look out for is rising interest rates. So the Fed's talked about, and they're probably going to raise interest rates this year.
Yeah.
Although, like I said, the 10-year's below 2%, and the Fed actually lowered the trajectory of where they expect rates to be. So I think rates still have a lot of room to run here over the next, probably really the rest of 2015. So you could get solid total return potential from this. But if you see rates start to rise quickly, or if you expect rates to rise quickly, you'd probably want to get out of companies like Medical Properties Trust, who are more interest rate sensitive.
So you think the Fed is just talking rates to death?
Basically, yeah. I do think they will increase that Fed's fund rate sometime this year, but they're going to be slow about raising rates after that.
Okay. Do you own this?
I do not.
All right. Check out more stocks, stock picking strategies, and stock commentary on our website, Zacks.com. Link to it all off the homepage once you get there, if you're not there already. With Todd, I'm Terry Ruffalo.